Imagine this. You live in London in the early 1800s. Everyone around you is talking about one magical company that will make you rich beyond belief. The South Sea Company. People say it's backed by the British Crown, by Parliament, by the very might of the empire itself. The air smells of opportunity, and even your uncle who still sells candles on Fleet Street decides to get in on the action. Sounds familiar, right? The next time someone tells you that a stock can only go up, just remember the story that started 3 centuries ago on those very same streets. Back then, Britain had a serious problem: debt. The government had borrowed vast amounts of money to fund endless wars in Europe and beyond. So when a group of clever merchants whispered the idea of turning that debt into an investment, politicians jumped at it. The South Sea Company offered to take on part of that royal debt in exchange for monopoly rights to trade with South America, the so-called South Seas. It sounded like free money. You give the company your bonds, the company takes over the debt, and then everyone gets rich trading gold, silver, and exotic goods from the New World. There was just one small problem. Britain couldn't actually trade with those regions because Spain controlled them. But hey, when greed kicks in, details like reality tend to be conveniently ignored. At first, things looked brilliant. The company's stock began to climb, pushed by wild rumors and glowing promises. Parliament gave its blessing. Newspapers wrote glowing articles, and even the king's family seemed involved. When ordinary Londoners saw the nobility buying, they assumed it must be safe. But, as always, a price driven by excitement rather than earnings is like a boat filled with too much cargo. It's only a matter of time before it capsizes. The stock's value tripled, then quadrupled. Coffee houses turned into trading floors. Everyone was speculating. Even Isaac Newton bought shares. And if the smartest man on the planet fell for it, what chance did regular folks have? Let's pause there for a second. The mechanism here isn't much different from what you'd see in any bubble today. Call it crypto, dot-com stocks, or even housing. All bubbles follow the same emotional curve. Optimism, excitement, euphoria, then panic and despair. When prices rise, it feels safe. You convince yourself there's a reason for it. You tell your friends, "Trust me, this one's different." But bubbles don't crash because people stop believing. They crash because there's no one left to buy. And when that happens, reality comes knocking fast. By mid-June of the year 1720, everyone wanted South Sea shares. People took loans to buy them, pawned jewelry, even sold their homes. Banks offered easy credit, thinking they'd just ride the wave for a bit. But remember what credit means: borrowed faith in future income. And when that future starts to look shaky, your lender suddenly wants their money back. The slightest shock can make the whole system crumble. That's exactly what happened when the company's directors started dumping their own shares quietly, selling to eager new investors who still believed the dream. Once whispers of selling began to circulate, the bubble burst with a thunderclap. Imagine the panic. Prices that had gone up 1,000% in months collapsed in days. Families lost fortunes, merchants went bankrupt, and the same newspapers that once praised the company now called for hangings. Newton himself lost nearly all his savings and supposedly declared, "I can calculate the movement of celestial bodies, but not the madness of men." The stock, once everyone's ticket to paradise, had become a financial black hole sucking in wealth and confidence alike. Entire sectors froze. Credit evaporated. A classic liquidity crunch. Lots of assets, no cash flow. Sound familiar? Well, it should, because some of those same dynamics reappeared in the crash of 2008, almost 3 centuries later. Now, let's break down what really caused this mess. At its heart, The South Sea bubble was a story about excessive debt and speculation driven by misplaced trust. The British government needed to roll over its debt, and the company offered a fancy trick to make it look profitable. Investors saw kings, nobles, and members of parliament buying, so they followed blindly, not realizing the game's logic depended on new investors constantly joining in. That's basically a proto-Ponzi. Early gains funded by latecomers. The stock price didn't reflect value. It reflected hope. And hope isn't a business model. At the same time, communication was poor, regulation non-existent, and information highly asymmetric. Remember, this was a world without Bloomberg terminals, quarterly earnings, or even reliable balance sheets. Rumors were currency. Confidence was leverage. When the company's promoters hinted at new trade treaties or royal backing, investors ate it up. No one asked, "Wait, what are we actually trading?" Instead, it was, "If others are buying, I should be too." The herd mentality took control. This is exactly what psychologists now call the greater fool theory, the belief that no matter how high the price, you can always sell to someone even more optimistic later. Spoiler, you can't. Eventually, you run out of fools. So what happened after the crash? Britain faced not just a financial crisis, but a political one. Many high-ranking officials were complicit in promoting the bubble. Parliament held furious debates. Companies went under, and mobs demanded justice. Some directors were imprisoned, assets confiscated, and a few scapegoats paraded through the streets. But the real damage lay deeper. Trust in financial markets took years to recover. Credit shrank, trade slowed, and the entire economy contracted. You might say this was one of the first modern recessions, a cycle of boom and bust seeded by debt and speculation rather than war or famine. It's worth noting that not everything was lost forever. Britain learned lessons from that disaster. Hard lessons. The government eventually stabilized its finances, introducing more oversight into public debt management. And investors too became slightly more cautious, though not for long. Within a generation, speculative fever would return in new forms. Foreign ventures, colonial schemes, railway stocks, and much later, industrial shares. Humans have short financial memories. Give prosperity enough time to rebuild confidence, and greed always comes back. Here's a fun thought experiment. Imagine explaining the South Sea bubble to someone today, swapping South Sea Company for a flashy new tech startup or a social media giant that's never turned a profit. You'd sound exactly the same. The phrases might change: network effects, user growth, AI expansion, but the math doesn't. When expectations outrun reality, a fall is inevitable. The South Sea scheme hinted that the global economy was already transitioning from tangible trade, ships, gold, spices, to intangible dreams, shares, promises, leverage. The modern world's financial DNA starts there. And speaking of ships, the metaphor fits perfectly. A ship overloaded with cargo can sail beautifully in calm seas. But once the wind turns and waves rise, every extra ton becomes a liability. In other words, leverage magnifies both profit and risk. The British system had leveraged its debt through the South Sea Company, inflating a financial balloon tethered to political ambition. Once that balloon popped, it exposed the delicate balance between government finances and private speculation. The same balance we still wrestle with today every time central banks intervene to steady markets. Let's also talk about the psychological dimension. Greed alone doesn't create bubbles. Credibility does. People believed the South Sea Company because it was tied to authority, to the crown, to the sense that this time is safe. The allure of legitimacy is stronger than spreadsheets. And when you mix official endorsement with human ambition, you get combustible optimism. It's not that investors were stupid, they were human. The genius of a bubble lies precisely in how reasonable it sounds while it's happening. Only hindsight reveals the insanity. Now let's connect the dots with modern economics. You'll often hear the term moral hazard. That's when someone takes risks knowing they won't bear the full consequences. The South Sea directors enjoyed that privilege. Their personal links to government meant even if the scheme failed, they expected protection. Sound like too big to fail? Exactly. The South Sea bubble introduced the first prototype of systemic risk, where private speculation threatened national stability. And every bailout in modern history echoes that moral tension. How far should public money go to rescue private greed? If there's one myth worth crushing here, it's that the South Sea bubble was a one-time blunder of ignorant investors. It wasn't. It was an early warning of capitalism's recurring fever for fast profits. It showed how revolutionary financial tools, then joint stock companies, now derivatives or crypto, tend to promise democratized wealth but often end up concentrating losses. It also introduced the dangerous illusion of easy money through financial engineering. And those lessons would resurface again and again. In the tulip mania, in the roaring 20s, in the 2008 housing crisis, different players, same playbook. So what came next for the unlucky victims of 1721? Many lost everything, yes, but others rebuilt. The British economy, despite the shock, adapted and eventually became home to one of the world's most sophisticated financial systems. Ironically, that resilience helped ensure that future bubbles could form again on even larger scales. Markets recovered, new investors entered, and financial innovation marched on. Because that's the paradox of crisis. Destruction breeds adaptation. Every crash leaves behind stronger institutions, until humans forget again. Before wrapping up, let's highlight our one-line cause and consequence. The cause: excessive speculation fueled by debt and blind trust in government-backed ventures. The consequence: a catastrophic market collapse that destroyed personal fortunes and reshaped Britain's financial governance. It's a story that set the tone for centuries of boom and bust cycles, reminding us that when faith in endless growth replaces reason, the fall will always hurt. So the next time you hear about a can't-miss investment opportunity, remember this old tale of ships, kings, and borrowed dreams. The South Sea Company didn't just sink investors' money, it charted the first map of financial folly. And that map, my friend, still guides the storms we sail through today. Close your eyes for a second and picture London in the year 1772. Coffee houses packed with merchants, ships unloading goods from every corner of the empire, and everyone talking about credit. Credit was the magic word of the 18th century, the invisible oil making the gears of global trade spin faster than ever before. But just like oil, it could catch fire. The very same trust that built fortunes could, with a single spark, burn the entire system down. And that's exactly what happened when one overconfident banker decided to play a game of financial dominoes. Let's travel back to that world for a moment. Britain had just come out of another wave of prosperity powered by trade, colonial expansion, and industrial beginnings. The empire was hungry for money to rebuild cities, fund enterprises, and finance wars. Instead of gold or silver coins, people used paper promises, bills of exchange and credit notes to settle debts and move capital. A bill of exchange was basically an IOU note between merchants, a promise to pay at a future date. Sounds fancy, but at its core, it relied purely on trust. If one signature lost credibility, the chain snapped. The problem? Everyone's paper was linked to everyone else's. In the middle of this credit web stood a man named Alexander Fordyce, a partner in a respected London banking house. Neil, James, Fordyce, and Down. These weren't just any bankers. They were the rock stars of their time. They handled funds for nobles, investors, and even other banks. Fordyce, charming and daring, took massive speculative positions in East India Company shares, betting that prices would keep rising forever. And when they didn't, he did what every over-leveraged investor does: borrowed more to cover the losses. Soon, He couldn't keep up the charade. Within weeks, his debts reached the kind of number you couldn't write on paper without breaking a sweat. And one summer morning in 1772, he vanished, literally packed his bags and fled to France. What happens when the man everyone trusts suddenly disappears? Chaos. London's financial circles erupted in panic. Merchants rushed to withdraw their funds, fearing contagion. Banks stopped lending to each other. The once smooth system of daily payments jammed like a broken watch. Remember, this was an era with no central bank backstop, no government guarantees, no lender of last resort. If your banker defaulted, your money was gone. Full stop. The failure of one major house set off a chain reaction that spread faster than gossip through the coffee houses. Dozens of smaller banks folded, trading houses collapsed, and the entire credit system toppled like dominoes. Here's where it gets interesting. The panic didn't stay in Britain. Those credit notes, remember, the fancy IOUs, circulated internationally. Scottish merchants, Dutch investors, even colonial traders in North America were holding British paper. When London sneezed, Amsterdam caught a cold. The Scottish banking system practically froze as banks refused to accept bills from any firm remotely connected to Fordyce's network. One after another, partners admitted their accounts were short. Wealth evaporated overnight as borrowers couldn't roll over their debt. What had looked like liquidity turned out to be illusion. Thin ice on a deep financial lake. Let's pause and unpack this mechanism because it's crucial. Liquidity means how easily assets can be turned into cash. If markets lose trust, everyone hoards cash, and liquidity dries up, even for solid institutions. It's like a crowded theater when someone yells fire. Maybe there's no real danger, but if everyone tries to exit at once, panic becomes reality. In 1772, the fire alarm was Fordyce disappearing. The theater was the British financial system, and the people rushing for the exits were merchants demanding their money back. Once confidence broke, the whole structure collapsed under its own weight. The Bank of England, yes, it already existed, had to step in, acting for the first time as a kind of proto-firefighter. It extended emergency liquidity to stabilize markets, though on a very limited scale compared to what modern institutions would do. This moment was historic. It marked one of the earliest examples of central bank intervention to calm a credit panic. Now think about that. A crisis caused by greed and leverage ended up creating the prototype of modern monetary policy. Sound familiar? Every major crash since has pushed institutions to step in, promising stability, while arguably paving the way for even larger risks next time. One crucial detail about this crisis: it started in euphoria. For years, British banks had been issuing credit freely. Unlike coins or bullion, paper money felt infinite. The more notes circulating, the richer the nation seemed. Merchants extended loans on the assumption that markets would always grow and goods would always sell. After all, the empire was expanding. Trade routes multiplying. Why worry? Yet unchecked optimism is the root of most financial disasters. When every loan depends on another person's ability to repay, and that depends on yet another, you end up with a pyramid of promises. One brick removed and the entire tower crumbles. It wasn't just a banking story. Real people suffered. Thousands of traders lost their livelihoods as international trade slowed sharply. Ships were left unloaded in ports, factories in Glasgow and Manchester reduced their pace, and unemployment spread. The downturn was especially harsh for average citizens who had placed savings in small local banks that folded overnight. There was no insurance, no regulator, no bailouts. Imagine waking up one morning to find everything you've earned evaporated because somewhere, someone gambled too much on East India stock. The anger was palpable, and the trust once placed in bankers shattered almost completely. You might wonder, how could they not see it coming? But predicting a credit crunch while it's happening is nearly impossible because everything looks fine until confidence vanishes. Numbers in balance sheets appear solid, letters of credit circulate smoothly, and everyone believes they'll be paid next week. That's the trap. Every participant thinks their counterparty is reliable. Only when the first major default hits do people realize how entangled everything is. The crisis of 1772 was basically an early warning that the world's first globalized financial system had been built on fragile trust. And that lesson applies just as strongly in our digital age as it did back then. The aftermath was brutal, but instructive. To restore stability, the Bank of England injected funds and increased its lending to solvent but illiquid institutions. A subtle but crucial distinction. Solvent means you have more assets than debt. Illiquid means you can't access cash quickly enough to prove it. That understanding became a cornerstone of modern central banking. The goal isn't to prevent losses entirely, but to avoid good businesses failing just because money stops circulating. In that sense, the crisis forced a maturity in economic thinking, even as it ruined countless lives. Pain often precedes progress. Let's dig a little deeper into how trust functions as the real currency in finance. Without trust, even gold loses its shine, because no one will trade it without confidence in the system enforcing its value. The crisis of 1772 stripped that layer bare. People realized that credit, by definition, is faith in the future. When that faith dies, money stops moving and economies freeze. It's chilling to think how this basic dynamic, so intangible, still governs trillion-dollar markets today. The actors have changed, but the emotional driver remains the same. Fear replacing trust in an instant. Now, picture a map. London, Amsterdam, Edinburgh, and the colonies. Lines of credit connecting them like nerves in an organism. When Fordyce defaulted, it was as if the organism suffered a sudden cardiac arrest. Trade collapsed, bills went unpaid, and debtors defaulted globally. Even across the Atlantic in the American colonies, merchants felt the shock as letters of credit lost value. In this sense, 1772 marks one of the first genuinely international financial crises. The world was learning the price of being connected. Globalization had a cost long before the internet made it trendy. In the months following the crash, Parliament launched investigations. Moral judgments were harsh, calling speculators parasites and gamblers. Fordyce, now a fugitive, became the poster child of greed. But the truth was more nuanced. The entire economy had built itself on dangerous assumptions that credit could grow forever without consequence. Fordyce just happened to be the first stone to fall. The culture of speculation went far beyond his firm. This pattern, finding one villain to explain a systemic flaw, would repeat endlessly in future crises. It's easier to blame a person than a structure. As the dust settled, commerce slowly revived. Many banks merged or reorganized, and the Bank of England quietly learned that stability required flexibility. Rules had to evolve. Stringent lending practices replaced reckless ones, at least temporarily. The idea of capital reserves, having enough liquid assets to survive a storm, gained traction. In a way, the crisis laid the groundwork for modern banking prudence, even as memory of the fear started to fade. And you know how that goes. Give prosperity a few quiet decades, and people start borrowing again as if nothing ever happened. Here's an interesting comparison. Think about modern credit cards or online lending apps. You swipe a piece of plastic, buy now, pay later, believing tomorrow will take care of itself. Multiply that instinct by every consumer and institution, and you have a similar credit pyramid. The tools changed, but not the human impulse behind them. The crisis of 1772, stripped of its wigs and candlelight, is the same story repeating through the ages. Optimism morphing into overconfidence, trust turning into denial, and denial smacking into math. Before wrapping this up, let's simplify the chain of cause and effect. The cause: uncontrolled growth of credit and speculative investments built purely on faith in continuous profit. The consequence: a sudden collapse of confidence that froze the world's first integrated banking network, spreading panic across Europe and the colonies. That's the domino of trust. Once the first piece tilts, nothing can stop the fall until every connection breaks. It's both terrifying and fascinating how fragile the whole architecture of finance can be. And here's the deeper lesson for you. Every modern crash, from Wall Street in 1929 to the global meltdown of 2008, began the same way. Too much borrowing under the illusion that tomorrow's profit will cover today's debt. The credit crisis of 1772 was just the first echo of this eternal rhythm. Trust creates wealth, but excess trust breeds madness. So the next time markets look calm, remember that calm waters can hide dangerous currents beneath. Because in finance, what you can't see is usually what sinks you. Picture it. New York City, autumn of 1929. Jazz pours out of hidden bars. Cars gleam under neon signs, and skyscrapers rise like promises into the sky. The decade has been one long party, an explosion of optimism after the First World War. Factories produce more than ever. Consumer credit is booming, and everyone seems to believe prosperity will last forever. But somewhere behind all the champagne and saxophones, a ticking clock is counting down to one of the most devastating crashes in history. The Roaring Twenties earned their name for a reason. America felt unstoppable, powered by new technologies like radios, automobiles, and assembly lines. The stock market became a national obsession. Everyone from factory workers to teachers invested in shares, convinced that modernity itself guaranteed growth. Brokers extended easy credit, allowing people to buy stocks on margin, meaning they only paid part of the price, borrowing the rest. It was like buying a mansion with just a down payment and hoping the value doubles before the bank asks for the rest. For a while, it worked spectacularly well. By 1928, price charts looked like straight lines pointing to heaven. Newspapers celebrated ordinary people becoming millionaires overnight. Bankers and politicians assured citizens that the market had reached a permanent plateau of prosperity. That phrase should sound alarm bells to you, because nothing permanent ever exists in finance. The nation became intoxicated by speculation. When profits began to feel effortless, the system started to rot from the inside. Let's break it down. An economic boom isn't bad by itself. It fuels innovation and wealth. The danger comes when growth depends on borrowed money and blind faith. By the late 20s, the Federal Reserve had kept interest rates low, making credit cheap and abundant. Consumers took loans to buy cars and appliances, while investors borrowed to buy stocks. The result was a pyramid of debt built on euphoria. One gust of fear could send it tumbling, and soon enough, that gust arrived. In October of 1929, warning signs began to flicker. The market showed small dips that nervous traders brushed off as healthy corrections. But beneath the optimism, something had changed. Investors realized prices were utterly detached from the real value of companies. There were whispers of factories slowing down, inventories piling up, and exports declining. On October 24th, later called Black Thursday, the illusion shattered. Prices plummeted, and the first wave of panic hit Wall Street. Brokers received thousands of margin calls, demanding more cash from investors who simply didn't have any. The chaos that followed was total. Within days, millions tried to sell, but there were no buyers. The ticker tape ran hours behind because the volume was so heavy. Men in suits huddled on street corners, staring at the sky in disbelief. Banks began to fail almost immediately because they had invested client deposits in stocks that were now worthless. This was the moment when the party turned into a nightmare. From Black Thursday to Black Tuesday, the bottom fell out of the American dream. You may wonder, how does a stock crash lead to a global depression? The answer is the chain reaction of panic and debt. When markets crash, wealth evaporates. People lose savings, businesses lose credit, and consumers stop spending. Less spending means lower demand, which forces factories to shut down and fire workers. Unemployment rises, banks fail, and confidence collapses further. It's a vicious circle, each step feeding the next. What started as a market correction transformed into an existential crisis for capitalism itself. By 1933, unemployment in the United States reached nearly 1/4 of the workforce. Imagine walking through New York and seeing bread lines stretching around the block, families sleeping in shanty towns called Hoovervilles, and farmers burning crops because they couldn't afford transportation. Global trade fell by half. The depression spread across oceans, dragging economies in Europe, Latin America, and Asia into the same dark pit. It was no longer just an economic crash. It was a human tragedy. One key factor that made things worse was the collapse of the banking system. Back then, deposit insurance didn't exist. When a bank went bankrupt, depositors lost everything. Once rumors began that certain banks were in trouble, people rushed to withdraw their money. Classic bank runs. Lines formed outside financial institutions, each person desperate to get their cash before the vaults emptied. It was a textbook example of how fear can destroy even healthy banks. If everyone demands liquidity at once, no system on earth can handle it. The Federal Reserve, the guardian of monetary stability, made a colossal mistake. Instead of flooding the system with liquidity, it tightened credit, aiming to protect the dollar's value. That decision strangled the economy. Low liquidity led to deflation, prices falling, but debts remaining fixed. Imagine your income dropping while your mortgage stays the same. It doesn't take a genius to see why people defaulted en masse. The Fed's hesitation turned a severe recession into the Great Depression. But let's not just blame the central bankers. Society as a whole had fallen under the spell of eternal growth. The ethos of the Roaring Twenties was pure confidence, a belief that modernity erased old risks. Speculation was celebrated. Saving was considered outdated. That mindset is the silent force behind every bubble. It wasn't just the financial elite at fault. It was everyone dancing on the same floor, ignoring the cracks beneath their feet. Now step back for a moment and visualize how this collapse looked from other parts of the world. In Europe, especially Germany, the Depression hit with brutal force. American loans had propped up European post-war reconstruction. When Wall Street imploded, that financial lifeline snapped. Factories went silent, unemployment spiked, and political discontent grew. You don't need to be a historian to guess where that frustration ended up leading, straight into the arms of extremist politics. The Great Depression didn't just destroy wealth, it reshaped global history. There's another layer here too: inequality. During the Roaring Twenties, productivity soared, but wages stagnated. The rich got richer, holding a massive share of national income, while the majority borrowed to sustain the illusion of prosperity. That imbalance meant that when the crash came, there wasn't enough broad demand to sustain recovery. And that's something economists still debate today: whether inequality itself acts as fuel for instability. The 20s certainly make a strong case. When President Franklin D. Roosevelt took office in 1933, he introduced the New Deal, a sweeping set of reforms designed to stabilize the economy. Banks were restructured, federal deposit insurance was introduced, and massive public works created jobs. For the first time, the government took active responsibility for economic welfare. It was both revolutionary and controversial. Critics called it socialism. Supporters called it salvation. But one thing was undeniable: the crisis had permanently changed how societies viewed their governments. Let's zoom in on one modern parallel, because it's worth your attention. In 2008, the world faced another credit-driven collapse. The instruments were different, mortgage-backed securities instead of stocks, but the psychology was identical: easy money, blind faith, and the belief that intelligent people had everything under control. The Great Depression was humanity's first brutal lesson about the cost of collective delusion. And yet, we needed to relearn it 80 years later. History might not repeat, but it sure knows how to rhyme. The emotional landscape of those years was profound. Fear replaced greed almost overnight. The same newspapers that once printed stories of endless prosperity now published images of despair. Investors lost not only their fortunes, but also their faith in the system. Entire generations became skeptical of markets. You can still feel the echo of that trauma today in the cautious tone of older investors who lived through later recessions, once burned, always wary. But out of the ashes came innovation too. Economic thinkers like John Maynard Keynes began to challenge old orthodoxies, arguing that markets aren't self-correcting and that governments must step in during crises. This intellectual shift led to the rise of modern macroeconomics. So yes, even as the Great Depression destroyed millions of lives, it also forced a paradigm change in how humanity understood its own financial machinery. Like a fever-breaking, pain-forced adaptation. Now, take a guess at the root cause. What really set everything up to fail? The cause: unregulated speculation built on excessive leverage and the illusion of eternal growth. The consequence: a worldwide economic collapse that redefined the role of government, reshaped public trust, and scarred an entire generation. Beneath the graphs and dusty history books, this crisis is a brutal reminder of one truth: you can't borrow your way to infinite prosperity. Debt comes due, always. Picture the world after 1939. The Depression didn't truly end until a war forced governments to spend massively, mobilizing industries and people. It's an uncomfortable truth that conflict became the engine of recovery. But it also cemented the lessons learned. Regulation matters. Safety nets save lives, and euphoria without limits destroys economies. The silent streets of the 30s were proof that markets are human inventions, and like all human creations, they can fail spectacularly when left unchecked. So next time you hear someone say, "This time is different," remember the roaring 20s and those silent streets that followed. Back then, they thought electric cars, radios, and modern finance would eliminate old risks. Sound familiar? The Great Depression wasn't just an event. It was a mirror, and the reflection it offers is one we can't afford to forget. Imagine this. You're driving a shiny car in 1973. Maybe a muscle car if you're in the States, or a compact if you're in Europe. The radio plays your favorite tune, but suddenly you hear an announcement that gas stations are running out of fuel. You check your gauge. It's half empty. No problem, you tell yourself. But when you reach the station, there's a line stretching around the block, and a big sign that says, "No more gas today." That's when it hits you. Something far bigger than your morning plans has just begun to shake the entire world economy. To understand the oil crisis of 1973, we need to go back to how the global energy system worked in the post-war decades. After the Second World War, Western countries experienced a period of spectacular growth called the Golden Age of capitalism. Oil was cheap, abundant, and taken for granted as the lifeblood of industrial society. Economies rebuilt, cars filled highways, and factories filled skylines. Nations built prosperity on an assumption that oil would always flow, and prices would always stay low. That illusion was about to break. At the center of this story lies OPEC, the Organization of the Petroleum Exporting Countries. Formed in the early 1960s by nations like Saudi Arabia, Venezuela, Iran, and Iraq, OPEC was created to wrest control of oil pricing from Western companies. For years, major oil corporations, many based in the United States and Europe, dictated prices unilaterally. OPEC wanted a seat at the table. By the early 70s, Those producing countries were gaining confidence and political power. Add a major geopolitical twist, and you get the spark that set the world ablaze. That spark came in October of 1973, when Egypt and Syria launched a surprise attack on Israel during the Yom Kippur War. Western nations, especially the United States, quickly supported Israel. In response, the Arab members of OPEC imposed an oil embargo on countries seen as allies of Israel. Overnight, the price of oil quadrupled. What cost $3 a barrel suddenly cost $12. It was a shock unlike anything the world had seen before. The energy lifeline of the planet suddenly constricted by politics. The effects were immediate and dramatic. In the United States, drivers waited hours at gas stations, sometimes fighting over the last few gallons. In Europe, governments introduced car-free Sundays, dimmed streetlights, and limited heating in public buildings. Japan, heavily dependent on imported oil, scrambled to rethink its entire energy strategy. But beyond daily inconvenience, the crisis ripped through the fabric of the global economy. Prices of transportation, manufacturing, and even food skyrocketed. And with prices rising but growth slowing, economists faced a new monster with an ugly name: stagflation. Stagflation sounds like something out of fiction, right? It simply describes the rare and nasty combination of stagnant economic growth and rising inflation. Normally, inflation happens when an economy overheats, and recessions bring falling prices. But in the 70s, both occurred at once. That broke the standard economic logic up to that point. Policymakers who had been trained under Keynesian principles to boost spending during downturns found those tools suddenly useless. Printing more money just fueled inflation while jobs kept disappearing. It was a dead end. For people living through it, the experience felt apocalyptic. Prices rose week after week, but wages couldn't keep up. Businesses closed as production costs exploded. Governments struggled to pay for imports as their currencies weakened. Investors lost confidence, and markets turned volatile. The oil shock punctured 2 decades of post-war optimism and replaced it with uncertainty and fear. The era of endless growth, the one born after 1945, was over. Energy scarcity had forced the world to recognize its limits. It's easy to think of the oil crisis as purely political, but it also revealed something deeper about modern economies: their vulnerability to resource dependency. For 30 years, the West had built consumption patterns and industrial models around cheap fuel. Suburbs expanded because commuting was affordable. Air travel boomed because jet fuel was cheap. Factories stayed open because energy costs were negligible. Once the price of oil spiked, every link in that chain tightened painfully. What was once invisible, energy, became the centerpiece of daily struggle. Meanwhile, oil-producing nations experienced an opposite reality: a sudden tsunami of wealth. The 1970s are sometimes called the petrodollar era for a reason. OPEC members saw their revenues explode. Places like Saudi Arabia built cities in deserts, Iran funded massive modernization projects, and Venezuela experienced a fleeting golden age. Yet that sudden windfall brought its own problems. Economies dependent on oil revenues became vulnerable to political instability and corruption. The curse of easy money struck again, just in a different form. The geopolitical consequences were enormous. Western countries realized they couldn't rely solely on the Middle East for energy. The United States launched efforts to increase domestic production and improve energy efficiency. Europe accelerated investments in nuclear power. Japan turned toward technological innovation to reduce dependence on fuel imports. You could say the entire modern environmental consciousness, the push for alternative energy, was born out of those long gas lines of '73. Humanity suddenly understood that infinite growth on finite resources was a myth. Economically, governments were forced to rethink their policies from the ground up. The old Keynesian model of demand management gave way to monetarism. the philosophy championed by economists like Milton Friedman. He argued that inflation came from too much money in circulation, not from oil itself. Central banks started focusing on controlling the money supply and raising interest rates. This shift marked the birth of modern neoliberal policies that defined global economics from the 80s onwards. In other words, the oil shock didn't just cause a crisis. It rewired the DNA of capitalism itself. Let's bring it down to street level. What did it mean for regular people? For many, it meant watching daily life get tougher. Gas rationing, layoffs, reduced consumption, and a sense of lost confidence. Housing markets froze, and consumer goods became expensive. The middle class, which had felt secure since the 50s, suddenly faced real financial vulnerability. For the first time, the dream of constant progress seemed fragile. You can imagine the tension, frustration at politicians, anger at foreign nations, and confusion at experts who couldn't fix it. The crisis also reshaped international relations. The oil-rich nations used their newfound leverage to assert independence on the world stage. Western diplomacy transformed from paternalism to negotiation, sometimes desperate negotiation. The shock exposed how power had shifted from the traditional industrial giants to resource-controlling states. Suddenly, the developing world had cards to play. Energy was the new gold, and whoever controlled it controlled the tempo of global politics. It's ironic, though, that the same crisis which empowered OPEC also sowed the seeds of its later decline. High prices encouraged energy conservation, new discoveries, and technological adaptation. As Western economies diversified energy sources, OPEC's grip loosened. By the late 80s, oil prices fell drastically, ending the producers' golden decade. But by then, the world had already learned a hard lesson. Dependence on a single resource could bring empires to their knees. Another important takeaway is how expectations shape reality. When people believe prices will rise forever, they behave in ways that make it happen. Hoarding, speculating, wasting. In '73, panic buying magnified the shortage. People filled their tanks even when they didn't need to, creating artificial scarcity. This psychological component is key in every crisis, whether involving oil or mortgages. Fear and greed push prices just as much as supply and demand. And once panic hits, logic goes out the window. Let's zoom out again. The oil crisis marked the end of the post-war economic miracle and began what economists call the era of volatility. Growth slowed, profits shrank, and inequality widened. Inflation became a ghost, haunting every government, from Washington to London. Political movements shifted rightward, emphasizing austerity, deregulation, and free markets. Leaders like Margaret Thatcher and Ronald Reagan built their policies as a response to what they saw as the failures of the 70s. So yes, that line outside the gas station changed more than fuel prices. It changed the ideological map of the world. There's a technological angle too. Before the oil shock, few people cared about energy efficiency. After it, car companies began producing lighter, smaller models. Home insulation improved. Factories modernized to use less power. Even the early discussions about renewable energy, solar, wind, and nuclear, grew out of this crisis. It's no exaggeration to say that the global environmental movement owes its momentum to those tough years. Crisis turned into catalyst. Now let's do the quick cause and consequence line, because all great disasters have one. The cause: geopolitical conflict triggering an oil embargo and exposing the world's dangerous dependence on cheap energy. The consequence: runaway inflation, global recession, and the birth of stagflation that reshaped economic theory and policy for decades. It was the moment when the 20th century stopped believing in infinite supply and started fearing scarcity. And if you think this no longer matters, well, look around. Every spike in oil prices still sends tremors through economies. Energy insecurity remains a weapon in global politics. The legacy of 73 echoes every time talks about green transitions or fuel independence takes center stage. The oil shock showed the world that prosperity isn't guaranteed, that even the strongest economies can stall if one tiny barrel becomes scarce. It was a global wake-up call, a reminder that the modern world runs not on dreams but on energy, and that those who control it hold the keys to stability or chaos. Let's fast forward to the late 1970s and early 1980s, when a new character steps onto the stage of global finance, the so-called emerging market. Maybe you have heard that term 1,000 times, but let's define it clearly. An emerging market is a country that is not poor in absolute terms, but is still catching up to rich economies in income, infrastructure, and institutions. Think of it as the teenager of the global economy. Growing fast, ambitious, full of potential, but also prone to risky decisions. And in this period, those risky decisions came wrapped in one powerful word: debt. Here is the setup. After the oil crisis of 1973, the oil-exporting countries suddenly found themselves drowning in cash from those expensive barrels. They deposited their money in big Western banks, which now had a problem: too many deposits. Not enough safe borrowers in rich countries. So what did they do? They went shopping for yield in Latin America, Africa, and parts of Asia. The sales pitch was simple. You are growing fast. You need roads, factories, ports. Take these loans and you'll pay us back easily when your economy is twice as big. To politicians in places like Mexico, Brazil, and Argentina, it sounded like free fuel for development. Throughout the late 70s, Latin American countries borrowed heavily in dollars. Dollar-denominated debt means you owe money in a currency you do not control. That is key here. As long as global conditions were calm and interest rates stayed low, servicing that debt looked manageable. Exports were rising, commodity prices were strong, and optimism was in the air. Governments used the money to finance big projects, subsidies, and sometimes very questionable spending. A lot of that debt did not go into productive investments. It went into prestige projects, corruption, or just covering budget holes. Then came the plot twist from the country of Uncle Sam. In the early 1980s, after years of high inflation, the United States Federal Reserve decided to slam on the brakes. Under its then chairman, it raised interest rates sharply to crush inflation. That move is known as a monetary shock. For you, as a consumer, higher interest rates mean more expensive mortgages and loans. For heavily indebted governments that borrowed in dollars, it meant something much worse. Suddenly, their debt became far more expensive to service, and global investors demanded even higher returns to keep lending. At the same time, the global economy slowed and commodity prices fell. Many Latin American countries earned dollars mainly by exporting raw materials: oil, copper, coffee, you name it. With lower export revenues and higher interest payments, their finances started to look like your credit card bill after a year of ignoring it. The moment of truth arrived in 1982, when Mexico publicly announced that it could no longer meet its debt obligations. That declaration was like pulling the fire alarm in a crowded financial theater. If Mexico could not pay, who was next? Brazil? Argentina? The panic spread quickly. Banks in the United States and Europe suddenly realized they had lent hundreds of billions of dollars to countries that might not pay back. For a moment, the global banking system was on the edge of a cliff. If all those loans went bad at once, major Western banks could have collapsed. So what happened? Enter the International Monetary Fund and the World Bank, the global firefighters of last resort. They stepped in with rescue packages, but as you can guess, that money came with conditions, very tough ones. Those conditions were called structural adjustment programs. Fancy label, simple idea. Governments had to cut spending, raise taxes, privatize state companies, and open their economies to foreign trade and investment. It was economic surgery without anesthesia. For the citizens of those countries, it meant austerity, higher unemployment, lower wages, cuts in public services, and more inequality. The 1980s in Latin America are now known as the lost decade. Economic growth stalled, inflation soared in some cases, and poverty increased dramatically. For an entire generation, the dream of development was postponed. Let's pause and look at the mechanism. The cause was excessive borrowing in a foreign currency, under the illusion that growth and low global interest rates would last forever. The consequence was a brutal adjustment when that illusion broke, with ordinary people paying for the mistakes of political and financial elites. Does the pattern sound familiar? It should, because a very similar script would play out again 15 years later on the other side of the planet. Different region, same ingredients: debt, optimism, and a sudden reversal of capital flows. Now jump to East and Southeast Asia in the 1990s. Countries like Thailand, Indonesia, South Korea, and Malaysia were the economic superstars of that decade. Their growth rates were spectacular. Factories were booming, and foreign investors could not get enough. They were called the Asian Tigers for a reason. Once again, huge amounts of foreign capital flowed in. Short-term loans, portfolio investments, and bank funding, often denominated in dollars. Governments maintained fixed or semi-fixed exchange rates, pegging their currencies to the dollar to reassure investors. For a while, everything looked perfect. Skyscrapers went up, highways were built, and a rising middle class shopped in gleaming malls. Credit was easy and cheap, and property markets became the playground of speculation. Banks and companies borrowed short-term in dollars because interest rates were lower, and invested long-term in local projects. That maturity mismatch, short-term borrowing to fund long-term assets, is like using your overdraft to buy a house. It works only if nobody suddenly asks you to repay tomorrow. Then came the turn of the tide. In 1997, investors began to worry that some of these countries were overheating. Current account deficits were large, meaning they were importing more than exporting and paying the difference with borrowed money. Asset prices looked inflated, especially real estate. Currency traders started to doubt whether the pegged exchange rates could be defended. So they pulled money out. Thailand was the first domino. Speculators attacked the Thai baht. The government burned through its foreign reserves trying to defend the peg, and eventually had to devalue. The devaluation was like shouting fire in that same crowded hall. Once the baht fell, investors assumed other regional currencies would follow. They frantically withdrew capital from Indonesia, Malaysia, South Korea, and beyond. Currencies collapsed, losing half or more of their value in a matter of months. Now think about what that means for dollar-denominated debt. If your currency loses half its value, the real cost of repaying your dollar loans doubles overnight. Suddenly, companies and banks that looked healthy became effectively insolvent. The crisis spread from financial markets to the real economy with brutal speed. Banks failed or had to be rescued. Businesses laid off workers or shut down completely. In Indonesia, the social impact was explosive, with riots and political upheaval. South Korea went from being one of the proudest industrial success stories to negotiating an emergency bailout with the International Monetary Fund. Once again, the rescue packages came attached to deep reforms: austerity, structural changes, and open markets. Citizens paid in unemployment, wage cuts, and lost savings. You might be thinking at this point, okay, so why do emerging markets keep falling into the same trap? The answer lies in the powerful attraction of foreign capital. When money is cheap globally, investors go hunting for higher returns in fast-growing economies. Politicians love it because it funds growth without immediate tax increases. Local elites love it because they can leverage and expand their influence. Everyone is happy until the global mood changes. Then those capital flows reverse, like the tide going out and revealing who was swimming naked, to borrow a famous phrase. There is also a key technical concept here: currency mismatch. When a country borrows in a foreign currency, it earns income mostly in its own currency, but owes in another. That is dangerous because it gives away control over your financial destiny. If your exchange rate falls, your debt burden explodes. Latin America in the 80s and Asia in the late 90s both suffered from this problem. They essentially imported not just money, but also vulnerability. And when global investors ran for the exits, that vulnerability turned into full-blown crisis. Still, it would be unfair to say nothing good came out of these disasters. Many countries learned from the pain. After the Asian crisis, several governments built large foreign exchange reserves as a kind of self-insurance. They strengthened banking regulation and reduced reliance on short-term external borrowing. Latin America, after years of hyperinflation and default, gradually developed more credible monetary policies and local currency bond markets. The scars of those crises pushed institutions to grow up, even if slowly and imperfectly. Let's do the quick one-line cause and consequence for both episodes. For Latin America's lost decade, the cause was massive external borrowing in dollars combined with rising global interest rates and falling commodity prices. The consequence was a wave of sovereign debt crises, brutal austerity, and a lost decade of growth for millions of people. For Asia's meltdown, the cause was excessive short-term foreign capital and fixed exchange rates that created a currency mismatch. The consequence was a sudden stop of capital, currency collapse, and deep recessions that reshaped both domestic politics and global financial thinking. Now, bring this closer to your own life. If you invest today, whether in stocks, bonds, or even crypto, emerging markets probably sit somewhere on your radar as high risk, high return. These stories explain why. Behind every glossy growth chart is a history of fragile institutions, external dependencies, and currency risks. That does not mean you should avoid them forever, but it does mean you need to understand the underlying dynamics. When the global tide of liquidity shifts, these markets move fast, both up and down. The bigger pattern should be clear by now. Debt, optimism, and the belief that good times will last forever create the perfect setting for disaster. It happened to the British in the South Sea era, to the United States in 1929, to Latin America in the 80s, and to Asia in 1997. Different continents, different decades, same human instincts. The world's financial system keeps expanding into new frontiers, but the emotional software running it barely changes. Greed, fear, and the temptation to overborrow remain constant. So, when you hear someone say that emerging markets today are more solid than ever, remember these episodes. Yes, progress has been made. Yes, institutions have improved. But the fundamental vulnerabilities, external debt, dependence on global capital flows, and political fragility are still very real. Latin America's lost decade and Asia's meltdown are not just dusty episodes for textbooks. They are signposts that remind you what can happen when a global environment turns against the countries most exposed to it. And as an investor and citizen, understanding that storm pattern is one of the best protections you can have. By the late 1990s, the world was entering a new kind of gold rush. Except this time, the mines weren't in California or Australia. They were inside your computer. The internet was exploding, and everyone wanted a piece of it. Entrepreneurs said the web would reinvent everything, from shopping to communication to money itself. Venture capital flooded Silicon Valley, and millions of small investors piled into hot new tech stocks. The age of the dot-com had arrived, and the air was thick with digital dreams and reckless optimism. Let's rewind a bit to understand the environment that fed this frenzy. After the Cold War ended, globalization pressed the accelerator pedal. Capital flowed freely across borders, inflation stayed low, and interest rates were cheap. The United States economy was booming, powered by innovation and the promise of a new frontier: the internet. Every newspaper headline shouted revolution. Companies that had no profit, no product, and sometimes not even a functioning website, were valued in the billions. Everyone, from Wall Street traders to high school teachers, thought they had discovered a risk-free road to riches. You already know how that ends. The logic of the bubble was simple and seductive. Investors believed that technology was rewriting economic rules, that the old concept of profit didn't matter, because market share was the new currency. As long as a company grew fast and burned cash to dominate its niche, success would eventually follow. Traditional valuation models looked outdated. The idea of clicks over cash became gospel. But when illusions replace earnings, prices start floating above reality, waiting for gravity to do its job. By 1999, prices reached levels that made no sense even in fantasy. The Nasdaq, home of tech stocks, more than doubled in 1 year. It was pure mania. Television commercials bragged about stock tips, taxi drivers gave investment advice, and new dot-com companies launched daily with ridiculous names and even more ridiculous valuations. You could sense the euphoria in the air. It didn't matter what the startup sold. If it had a .com at the end, people bought its shares. Then came the turn of the millennium, and with it, the reckoning. When some highly hyped companies began missing earnings forecasts, confidence cracked. Investors started asking uncomfortable questions. When will these companies actually make money? The answer, often never, sent shockwaves through markets. In early 2000, selling began and turned into panic. Within 2 years, the Nasdaq lost nearly 80% of its value. Trillions in paper wealth evaporated, and thousands of startups disappeared overnight. The digital dream had run headfirst into hard math. So why does this story matter beyond the obvious? Because the dot-com crash was the first global financial crisis of the digital age. It revealed how psychology, not just technology, drives markets. Bubbles are less about innovation and more about collective belief. Belief that this time is different. Investors forgot that behind every shiny app or promising idea, there has to be a sustainable business. But here's the twist. While many were ruined, the infrastructure built during that bubble, servers, fiber optics, and new knowledge, laid the foundation for the real digital economy that followed. Even in failure, bubbles sow seeds for the next boom. Fast forward a few years to the mid-2000s, and you'll see a very different kind of frenzy building. This time in bricks, not bytes. The housing market became the new casino. After the mild recession following the dot-com bust, central banks kept interest rates low to support recovery. Cheap credit flooded the system again, but instead of tech startups, it flowed into homes. Real estate, the most tangible asset of all, became the world's favorite investment. And once again, people convinced themselves that prices could only go up. Let's break down how that housing bubble, which led to the 2008 financial crisis, actually worked. Banks and mortgage lenders began offering loans to virtually anyone, people with little income, poor credit, or no savings at all. These were called subprime mortgages. But here's the twist. Banks didn't keep those risky loans. They bundled them into financial products known as mortgage-backed securities, then sold them to investors all over the world. In theory, the risk was diversified. In reality, it was just repackaged and multiplied. When you slice those bundles into smaller bits and label them with confusing jargon like tranches or collateralized debt obligations, people stop asking questions. Rating agencies stamped them as safe. Investors chased yields, and Wall Street pocketed fees every step of the way. Money felt endless. Families bought multiple homes, sometimes just to flip them later at higher prices. Every dinner conversation revolved around real estate. It was the American dream on steroids. But it wasn't just an American phenomenon. Similar bubbles brewed in Spain, Ireland, and even Iceland. Then came the trigger. In 2007, housing prices stopped rising. Homeowners who had borrowed too much began to default. The dominoes started to fall. Suddenly, those supposedly safe securities lost value. Banks couldn't sell or price them because nobody knew which ones were toxic. Within months, major financial institutions were on the brink. Bear Stearns collapsed first, then Lehman Brothers, one of the biggest investment banks in the world. The shock sent tremors through every financial artery on the planet. By the autumn of 2008, panic had gone global. Credit markets froze, stock markets imploded, and millions of people lost jobs and homes. What started as a housing glitch turned into a systemic failure of trust, the same invisible glue that holds the financial system together. Governments rushed in with bailouts and stimulus programs. Central banks slashed interest rates to zero, and extraordinary measures were taken to prevent complete collapse. For a few weeks, the world really did stand at the edge of financial abyss. The key to understanding that catastrophe lies in leverage and opacity. Leverage means using borrowed money to amplify profits or losses. Financial institutions had taken on insane levels of it, all justified by complex models that assumed markets would stay stable forever. But when confidence cracked, leverage became poison. The entire system was a gigantic Jenga tower balanced on debt. Once one block, housing slipped. The rest tumbled in slow motion. The social cost was enormous. Families lost not just homes, but life savings. Younger generations entered job markets frozen by recession. Governments saw public debt explode as they rescued banks. The resentment that followed reshaped politics, giving rise to populist movements across continents. The 2008 crisis wasn't just economic. It was emotional, moral, and cultural. It shattered faith in the idea that markets always self-correct and that experts always know what they're doing. Let's pause for the quick cause and effect summary here. The cause: an unsustainable boom in housing fueled by cheap credit, complex financial engineering, and blind faith in continuous price growth. The consequence: a global financial meltdown that wiped out trillions in wealth, destabilized nations, and forced historic government intervention. Once again, the villain was the same old trio: debt, euphoria, and lack of oversight. Different stage, same play. But our story doesn't stop in 2008. The aftermath gave birth to a new financial landscape shaped by two forces: ultra-low interest rates and digital transformation. The world learned to live with constant stimulus, quantitative easing, and zero-rate policies. Money became cheap again, encouraging the next wave of speculation, this time in tech giants, cryptocurrencies, and startups promising the future. The dot-com ghost had returned, just wearing a sleeker suit and powered by algorithms. Think back to the Bitcoin frenzy of the 2010s or the meme stock mania during the pandemic. Each episode echoes the same logic: easy liquidity, viral enthusiasm, and collective belief that someone else will always pay more. Technology changes, but human behavior doesn't. Investors chase hype cycles the way sailors chase mirages. They know it might vanish, but the temptation is irresistible. Even today, when the next big disruption appears, people forget the crashes of the past with astonishing speed. It's worth reflecting on why these modern bubbles feel different yet familiar. The tools of speculation have evolved: apps, online brokers, social media. But the core dynamic is identical to what happened in the South Sea bubble 3 centuries ago. Excess cash, excess confidence, and the absence of regulation add up to the perfect storm. In 2008, it was housing. In the late 90s, it was dot-coms. Tomorrow, it could be artificial intelligence, green tech, or something no one has imagined yet. History doesn't repeat, but greed insists on rhyming. Now, let's connect the dots across all the crises we've covered. From the South Sea bubble to the Great Depression, from the oil shock to the Asian crisis, from housing collapses to digital manias, every single one shares a pattern. It starts with innovation or opportunity. Hope turns into speculation. Speculation breeds excess. oversight lags behind euphoria. Then, reality breaks the spell, and the system purges itself in pain. It's the emotional cycle of capitalism, recurring generation after generation. So why do we keep making the same mistakes? Because financial systems run on emotion as much as on math. Fear and greed aren't bugs. They're features baked into how humans make decisions. Regulation can temper them, technology can disguise them, but they never go away, and that's why crises will keep happening. The question isn't whether we'll face another one, but when and what form it will take. If there's one lasting lesson from the modern crashes, from the dot-com bubble to 2008, it's this: debt amplifies everything. It magnifies gains in good times and multiplies losses in bad ones. When optimism fuels borrowing, the seeds of collapse are already being sown. A healthy economy isn't one without risk, but one that remembers risk exists. Forget that, and history puts you back in class with another painful lesson. To close this journey, let's leave a final thought. The cause of nearly every major crisis in history can be boiled down to excessive leverage, unregulated optimism, and collective amnesia. The consequence is always the same: a painful correction that forces societies to reinvent their economic rules. Learning that rhythm doesn't eliminate risk, but it helps you navigate it. So, stay curious, question the hype, and remember, in finance, the same storm keeps returning, just wearing a different disguise.